Mr. Sanjeev Verma, Whole-Time Director and CEO of Blackbox Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone. Welcome to Blackbox Limited's Q3 and 9-month FY25 earnings call. I'm joined by Deepak Bansal, our Executive Director and Global CFO, Purvesh Parekh, Head of Investor Relations, and our advisor, SGA. I trust you have reviewed our results presentations, press release, and financial release, all of which are available on the exchanges and our website. Let me start by providing some context for Blackbox position in the IT industry. Gartner projects global IT spending to reach $5.7 trillion in 2025, with IT infrastructure accounting for $600 to $750 billion. Our total addressable market is approximately $120 to $150 billion, or 15 to 20% of that, presenting a significant opportunity. We are targeting 1.5 to 2% of this market to reach $2 billion in revenue by FY29. I'm pleased to report our highest ever quarterly and 9-month PAT in FY25, alongside strong EBITDA performance, which Deepak will explain later. As we move into fiscal 26, we are focused on expanding our footprint with the top 300 customers and capitalizing on the growing digital infrastructure opportunities. AI-driven models are accelerating demand, particularly from hyperscalers like Amazon, Meta, Alphabet, and Microsoft, who are investing over $325 billion in data centers and cloud services this year. We are positioned to benefit from this. Recently, we secured a major data center order from one of our largest hyperscalers, including 3 large US sites and a 250 crore order. Additionally, we have won significant orders across cybersecurity, network integration, and airport infrastructure. We are confident that demand for digital infrastructure will remain strong across industries. While Q3 and 9-month FY25 revenue growth was impacted by a subdued order book, we remain focused on acquiring high-value customers and optimizing operational efficiencies. The order pipeline has strengthened with a sequential increase to $465 million, approximately 3,900 crore as of December 2024. We have secured $80 million in orders so far this quarter and expect strong momentum to continue into Q4 and FY26. For FY25, we have revised our revenue guidance to 5,925 to 6,000 crore due to delayed decision-making and our strategy to exit lower-value customers. 80% of our business comes from top 200 customers, many of whom are Fortune 500 companies. Going deeper with these customers is our priority. Notably, contract cycles have extended due to some delays, but we are confident this will improve as we move forward. For FY26, we anticipate revenue growth to 6,750 to 7,000 crores, driven by an expanding order book and a stronger win rate from large enterprise and high-value opportunities. This momentum should positively impact revenues from Q2 FY26 onwards. Despite the lower revenue guidance for FY25, we are on track to meet our revised EBITDA guidance of 525 to 535 crore, reflecting a 23 to 25% increase from FY24. EBITDA margins of 8.9% for FY25 are above our previous expectation due to improved efficiency and focus on quality of revenue. For FY26, we expect EBITDA to range from 605 to 645 crore with a margin between 9 and 9.2%. We have also revised our FY25 PAT guidance to 205 to 210 crore, reflecting an exceptional impact. However, this still represents a 50% growth over FY24. For FY26, we expect PAT to grow 30 to 40%, with a target of 265 to 285 crore. I will now hand over to Deepak to take you through the financial details.
Thank you, Sanjeev. Good morning, everyone. Let's review our financial performance for quarter 3 and 9 months ended for FY25. Revenue for quarter 3 stood at rupees 1,502 crore, slightly above quarter 2's 1,497 crore, but down from rupees 1,655 crore in quarter 3 of FY24. For the 9 months, revenue reached rupees 4,422 crore compared to 4,801 crore in the same period last year. Subdued order book and delayed decision-making impacted revenue, but strong order growth in quarter 1 of FY26 gives us confidence in meeting our FY26 targets. On the EBITDA front, we delivered strong growth. Quarter 3 EBITDA rose 15% year-on-year to 134 crores, while for 9 months ended, EBITDA grew 25% year-on-year to rupees 385 crores. EBITDA margins improved significantly, up 190 basis points year-on-year to 8.9% in quarter 3 and 230 basis points to 8.7% for 9 months FY25, thanks to better efficiency and quality of revenue. Quarter 3 FY25 profit after tax reached a record 56 crore, reflecting a 37% YOY increase. For 9 months FY25, PAT grew 49% year-on-year to 144 crore, with PAT margins improving by 120 basis points year-on-year to 3.7% in quarter 3 and 130 basis points to 3.3% for 9 months FY25. We continue to generate strong returns on equity and returns on capital employed, along with positive cash flow. Based on our strong order pipeline, we are confident in achieving our FY26 guidance across all parameters. That's all from my side. Sanjeev and I are now happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deep Shah from B&K Securities. Please go ahead.
Yeah, hi. Good morning. Thanks for the opportunity and congrats on substantially improving your margins. I think this is in line with what we have been saying for some time. Sir, so if I were to further emphasize on this, we've been saying that we want to touch the long tail of clients and focus on top 300. But what we've seen this quarter is that sequentially number of clients in revenue buckets of more than 5, 25 and 50 crore, they have declined. So could you help us explain this divergence that we are focusing on top clients, but then number of clients in top brackets have come down?
No, yes, I'll take that. So I think we are looking at point in time. Of course, there are several clients in those buckets which are renewed periodically, and there are also projects or order in motion. So as we move forward, we'll see those changes. We'll continue to focus on our top 300. There is a timing issues of when those contracts are renewed. For example, in the coming quarter, we are looking at a very large healthcare contract to be coming back for several years. So that will change, and it could be possible that in a quarter we have several of such. So when we take a situation for 9 months or a particular quarter, there could be small adjustments there. But our go-to-market strategy now with verticals and horizontals that I've said before will continue to focus on our top clients and ensure that we are able to increase those various buckets of 50, 100, 200 crores customers going forward.
Okay, understood. So, would it be fair to say that this number we should look maybe on a Y-on-Y basis or on a yearly basis? That would be fair?
That would be fair statement, yes.
Understood. So second question is on this order book. So you highlighted that you won about $80 million worth of orders post the end of the quarter. So typically, sir, what part of our revenues flows into, I mean, there are large orders which become part of order book and then they are executed versus, say, ongoing services. Another way to ask this question would be that what would be the typical duration of this order book, $520-$530 million now, to convert to revenues?
So we usually take on an annualized basis for our contract revenues and a total value of projects for our project order booking. An average cycle of a project order booking is about 9 months. Some are going to 2 years' time, some 18 months, but an average between 9 and 12 months' time. So a fair view to look at order booking would be on an annualized basis. So between 60 and 65% of our revenues are covered through the order book at any point of time. We are working to make sure that as we get into larger deals, to improve that coverage on any quarter from the current 60% levels to maybe 65, 70 as we go forward, focus on larger deals. So in summary, we take project order values from our order book perspective when we report, and we take annualized contracted value of contracts to report order book.
Understood. Fair. This is helpful. So one last question, that now we've had severance costs for many quarters, and we are probably seeing some benefits of it in terms of our margins, efficiencies are improving. But what is the idea here, that how much leaner you think the organization needs to become? How long will this continue? And what is the end goal here? How many clients do we want to service? How many employees do we want to keep? I understand we've been reducing employee count. So any idea here would be helpful, because this severance cost is substantial, right? It's like 13 crores this quarter on an EBITDA of 130 crores.
So I'll take the later part of the question and then I'd defer to Deepak with respect to severance costs. With respect to how many clients, so our focus, like I just said, is to focus on larger clients and larger deals. We have a total basket of close to 1,500 odd clients, and we are benchmarking that we would be wanting to serve or progressively serve clients to a level of where the potential for us for $1 million. That's the benchmark. We are not there at this time. Focusing on top to 200-300 of our customers, and then others which we see at least a baseline, because we cannot afford to be everything to everybody. So that's our focus. With respect to with scale, we will gain some operational efficiencies as well. So therefore, it's not a linear investment in people as we start to scale. So we'll see that operating margins gradually improve as we start to build scale. With respect to how long do we see the severance costs in the short term, I'll defer to Deepak to respond to that.
So Deep, what is happening is that like that we continue to optimize the efficiencies in the whole ecosystem, and we still think that there is a little bit of scope there to improve and all those things. So it's like a continuous process we are running right now, and we are expecting that for next, let's say, 3 quarters at least, we are expecting the severance cost to continue, because it's like we think that this is over and now we have nothing to do, and then again we put a review process and again we see that okay, these are the 10 people again which we can remove or which we can move India or not required or whatever it is, and then the severance cost comes in. In this quarter specifically, or let's say on the last quarter, there is a lot of people we have removed in Europe, and because of the Europe thing, the amount of the severance is little higher as compared to what it happens in US. So we are revisiting everything in across the world. It will continue for next 3 quarters more, so that we continue to optimize our efficiencies and do more in less.
Understood. This is helpful. Thanks, Sanjeev. Thanks, Deepak. Deepak, one last question for you, and this is purely bookkeeping. If I look at our guidance, and I take midpoint of a guidance for simplicity, the delta in absolute rupees of increase in PAT is actually lower than increase in EBITDA. I mean, this does not sound right if we assume that severance cost is going to be there only for next 2 quarters, because this year we had severance costs for the full year, plus we should have some interest cost reductions, both because of rates are expected to come down, and we've raised 100 crores, we raise another 300 crores in the next year. So could you just explain how are these guidances given, or is it that you've been extremely conservative to not miss the guidance? If you could explain that, it would be very useful.
Three things here. One is that we have assumed the severance cost will continue for 3 quarters in the next fiscal year. That is number one. Number two, what we have assumed is basically we have not assumed that the interest rates will come down. We have not assumed that. And also on the growth, because we are talking about a growth of close to around 750 to 1,000 crores type of growth on the current year revenues. So for that, obviously the working capital will come in, and for that purposes, because we need to put upfront working capital, so there will be a little bit of interest cost on that securitization, what we will do, the receivable and all those things, that will come in there, and then little bit of, let's say, 2% increase in the tax on the profits which will come. Then we didn't want it to be expanded more, wanted to be a little bit conservative in terms of overall numbers, and that's how if you see our EBITDA, the EBITDA is going up by close to around 80 crores, let's say at the lower range of the guidance, and the PAT is going up by 60 crores. So it's a 20 crores type of the difference which is there, which comprises of all these things.
Understood. This is very, very helpful. Thanks, Deepak. All the best, Sanjeev and Deepak. Thank you so much.
Yeah. Thanks. Thanks.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of CA Garvit Goyal from Invest Analysis. Please go ahead.
Hi, am I audible?
Yes, sir.
Good morning, sir. I have 2-3 questions. One is on our top line. So over the past 3 to 4 years, our top line growth has been muted, while profitability has improved primarily due to cost-cutting measures like reductions in employee costs and service charges. Here I am having two questions. One is, what are the primary challenges that are preventing us from accelerating the top line growth? Like, despite our focus is on data centers and go-to-market strategies, we have reduced our revenue guidance. And additionally, if we see, data centers are not a major portion of our revenues, and even there we are citing like customer capex delays are happening. So, given that the high quality profit growth is driven by the top line expansion rather than the cost cutting, how do we plan to achieve like sustainable revenue growth of 25 to 30% moving forward? That is one. Secondly, on while we position ourselves as a provider of specialized IT solution company, our PAT margins are very low at 2-3% in comparison to even general IT companies that achieve 6 to 7% PAT margins. So is it due to intense competition that is limiting our pricing power, or are there any other structural factors at play? So can you provide more insights like why our margins are relatively low and what steps we are taking to improve them, sir? So that is the one question, sir. So please, sir.
So I'll take that. I think, yes, our order book and revenues have been muted over the last several years' time. As I had told in my earlier earnings call, I think Blackbox historically has been serving a very large bunch of customers, over several thousand, and we were trying to be everything to everybody. and we embarked upon initially to focus on margin growth, margin expansion, because 3 or 4 years back when we acquired, there was no margin. So our focus was largely on margin expansion, and that's what we did. Over the last couple of years, I think we have pivoted to become a specialized global digital infrastructure player at the back of growth for data centers and AI. To that extent, we had to change our go-to-market motion to be able to go deeper than wider. We have employed and engaged with Boston Consulting to reorganize our go-to-market focus, as you know, to be able to do that. Our entire invested in our vertical motions, bringing in a lot of top industry leaders in verticals and horizontals the last several quarters. The effect of that investment in verticals and horizontals is starting to take shape as we speak. And as we get into our fiscal 26, we expect the order book momentum to be able to take us to our guidance and growth overall over the next several years' time. Large projects have certain challenges with respect to timing, and therefore we had those challenges in this year where our revenues remain muted. Expect our current order book and pipeline, which stands robust of over $2 billion, to be able to help us increase our win rate. Our win rate in our large deals has been lower. With focus now in verticals across technology, financial services, hyperscalers, healthcare, and so on and so forth, we expect our order booking to gain significant momentum starting from Q4 onwards, getting into the next fiscal year. So we believe our current guidance for the next year, which allows us to grow mid double digits in 13 and 17%, confident of being able to do that. Your second question pertaining to our PAT and stuff. So we are not comparable to a regular IT services offshore company. That's not our model. Our model is largely local. We are a local digital infrastructure company, so therefore we have larger resources onshore than offshore. We, of course, use offshore appropriately to be able to expand our margin, to build our service delivery wherever we can, but more importantly, our back office and shared services. Our guidance pertaining to EBITDA margins is 10%. The industry EBITDA margins for our kind of infrastructure integrated business locally and globally is in the range of 8 to 12%. So we have currently focused on taking our EBITDA margins to be in the range of 10%, and then from there, with scale, work forward to see whether we can improve that further 10% to 11 and 12 going forward. A PAT, of course, is an element of our cost of money, depreciation, and other exceptional factors, as Deepak alluded. We have seen over the last year or more than that, the interest rates to be high. As we scale up our business and get into fiscal 26 and fiscal 27, we expect not much of our cost below the EBITDA line to increase in a linear fashion. So we will see our PAT margin inching up more towards 4, 5, 6% over the next 3 years' time. Deepak, you want to add something on drop between EBITDA and PAT?
Yeah, two things I want to add. One is that on the PAT side of it, we are mostly a onshore company. We are not an offshore company like the other IT service providers from India is. We have 90% of our people on ground. So let's say if our majority of the business, which is 3/4 of our business, comes from America. So we have the people on the ground. We have close to around 2,200 people on ground in United States. So from that perspective, we are not comparable with the Indian IT service providers. We are IT digital infrastructure provider. We are not IT service provider.
Understood, sir. And so you mentioned $2 billion target by FY29. So from the current levels, if we want to achieve that number, we have to grow at a CAGR of around 30%. But for next year in FY26, you are saying even backed by the orders that you are expecting in upcoming quarters, we are guiding for a growth of like 15-17% kind of number. So is it like the major expansion in the turnover is going in FY27 and onwards?
So I'll take that. So yes, I think our $2 billion aspirational goal in by fiscal 29 also includes a decent portion of inorganic that we do not talk about. So we expect organically to be in the range of $1.4-1.5 billion, and we expect some inorganic stuff as you move forward included in that. We expect our organic motion as we move forward from the current 15-17 levels to move to 20s. And the gap between that organic growth of nearly 20% as we move forward to fiscal 26, 27, 28 and beyond is also to see that we are able to acquire assets that we believe are accretive for our shareholders. And we will talk about them when we get ready to be able to do that.
Understood, sir. And just a clarification on the order inflow. Like you mentioned that one of the world's largest hyperscaler has allocated us 3 large sites in the US. And additional to it, you have mentioned like 250 CR order from this long-term customer only. So could you clarify like whether this INR 250 CR order includes those 3 large sites, or is there any additional order value associated with these specific sites? And if so, what is the incremental order value for these three sites?
Yes, so the current 250 crores quoted does not include all the new sites. The new sites, the order comes through a lag. It first comes through an allocation, then a discussion and the order book. So yes, there will be more order flowing with those 3 new sites. 2 of them has not seen an order yet. So we expect order in the range of 200 to 400 crores additionally from this customer for those new sites in the coming quarters.
Understood, sir. And based on our order filings,
sir, I would request you.
Just last question.
Okay.
So, based on the order filings this quarter, the total value of incremental orders like in Q3 is around 400 CR, which seems relatively small compared to our existing top line. So in the last phone call and in the today's phone call as well, you mentioned a strong order pipeline is there and expectations of securing the sizable orders to drive growth in the years ahead. So, however, considering the current order inflow and our stated revenue growth of 13 to 15% for FY26, there appears to be a disconnect. Like, could you provide more clarity on like how the incremental orders are going to be big enough to drive our this kind of growth that we are aspiring to?
So we actually provide overall order bank at the on the earnings call at the end of a quarter. So the overall order bank or order backlog that we have provided for is marginally higher than our previous quarter. As we get into the quarter 4, we expect our order book to close even larger compared to what we are showing now. So we expect our quarter 4 order book to be much higher. So I think it's not a point in time of order book that we booked in Q3. The overall order book is 10 billion more than the previous quarter. As we get into our new fiscal year, we expect to open up with a larger order book compared to that will drive growth going forward in fiscal 26. Also, our current pipeline, based on our assessment, has a significant traction to be able to book bill and revenue in the next fiscal year, giving us confidence for the guidance that we have given for a 15-17% organic growth in next year.
Okay, so thank you very much, sir, and I join back the queue.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Vivek Joraria, who is an individual investor. Please go ahead.
Hi, Sanjay. I've got two questions, one slightly near term and one long term. I mean, can you just point out and talk to how our change in our go-to-market strategy is impacting our organization? Because we've been talking about a double-digit growth for the past 6 quarters, but that hasn't come about. What gives you the confidence that now, I mean, you've been talking about a delay in order taking. And in the same day, we are talking about a double-digit growth starting from next year. Are you confident enough to achieve that? Because we've been talking that for a long time. I think do you think you'll start walking the talk from, say, Q1 or Q2 onwards? Because we don't have much runway left for the margin part. So I guess that the company needs to start firing on the top.
I'll take that, Vivek. So yes, I think from a renewed go-to-market, this thing, we started the initiative early on in fiscal 25 by engaging Boston Consulting. Our top stack for our sales leadership with respect to vertical leaders across financial services, technology, healthcare, consumer, and other sectors were completed in the middle of this fiscal year, and they are in motion. We also invested heavily in our horizontal practices to be able to support that, be it in connectivity or data center and workplace. We are starting to see those results with respect to pipeline building on large value orders. Engagements are of two nature. One, of course, participating in growth. That's your build out of infrastructure, be it airports or data center. And then, of course, displacement-led growth, which you have to get the right to win. A combination of two will allow us to do that. Our large deal pipelines in the Q3 getting into Q4 is significantly larger. Our quality of engagements with our top customers, the top 300, is much better and deeper. I'm personally engaged in many of those conversations as well. So as I told earlier, we expect our order book to gradually improve from where we left the first two quarters. The quarter three was slightly better, but not as much. We expect that to be much better in quarter four, leading us into fiscal 26. And our ability now to not only participate and get considered, but our account management, deeper engagement will allow us to increase our win rate. Our win rate for large deals was much less compared to what we expected to be. We expect our win rate for large deals in the range of 20-25%, which is fairly low at this time. And that itself will allow us to propel significant order booking uptick, which will then convert to revenues going forward. So I feel confident with respect to fiscal 26, double-digit growth, with the motion that we've had over the last 6-9 months. Large deals take up a little bit of a time to mature. Displacement growth requires a bit of a time. And then faster adoption of AI and build out of data center for what we've seen today also throws us larger opportunities for us to be able to participate in those. We are engaged in those conversations. So combination of robust pipeline, increasing our win rates, deeper engagements with respect to our conversation that we're having with our customers, quality of revenue, and the combination of that, we feel confident for our growth momentum in fiscal 26 and beyond.
Sanjeev, just to clarify, so we're basically guiding for close to 15 to 18% top line growth or organically for the next 4 years, and then the acquisition comes on top of it. We've been barely able to go top line. I mean, that's quite a tall ask. I mean, I hope you guys have your plans in place to deliver, because it's like it will be quite a task to deliver, say, 15% growth or organically. I mean, as we are sitting in Q4 of 25. So when do you think we'll start seeing those numbers on the P&L? I mean, so should Q2 be a fair expectation to see a double-digit growth on the top line?
So I'll give you two answers. One, of course, yes. So I think considering our muted results from a growth perspective in this current year, your question is valid. As we told earlier, we've also been working with respect to eliminating some of our non-accretive long tail, and I address that by the quality of revenues. So the answer is yes. We expect starting from Q2 of the next fiscal year to see those double-digit growths to be able to allow us to reach our guidance of overall double-digit growth in the fiscal 26. Our order pipeline getting into quarter four looks good. Our order pipeline, our order backlog getting into quarter one of fiscal 26 will look better, and momentum will continue. So fiscal 26 quarter two onwards for the next several quarters, getting those high double-digit momentum to lead us into our guidance of 15-17% organic growth is what we are confident about in fiscal 26.
Sanjeev, just one last qualitative question. How different do you feel our company is now? I mean, with the change in the go-to-market strategy and with the recent top level hires, do you feel more confident now that we can finally scale? Because I mean, just speak to it qualitatively. I mean, if we were able to participate in a $10 million order, now can we now see our company participating in much higher orders of magnitude? Just I mean, so if you can just speak in terms of the quality of the bench that we have now, and how confident do you feel?
Yes, I believe I'm very confident with the quality of bench that we have with respect to the leadership. We've also added in the last 2 quarters specifically 20 new sales business development hunters from industry experience that we desired. Some of these have taken time to bring them some on board. So the quality of leaders in verticals and horizontals, the quality of engagement that we're having and the size of the deals that we're having is much better. You'll be able to see some of those. For example, we're now engaged with a fairly large deal with the healthcare that is going to culminate, for a long-term contract. We're also seeing on the modern workplace our engagements pertaining to AI adoption, and we will be talking about those in the coming quarters as well. So qualitatively, our level of engagement, the quality of engagement that we are having now with our customers, with the team that we have, overall management team, the sales management team, and the sales business developers are much better. That will provide some confidence. I'm personally engaged with the mentoring and engaging with some of these top customers, and I believe bullish about the quality of people. We'll continue to add more, hiring more high-quality talent, especially in terms of sales as we get into this. We will be focusing deep dive. We have picked up our top 100 customers for deep dive account management out of the top 300. And each of our vertical leaders are responsible to own up several of those. So if 10 of those, including myself, own up 5, 10 to mentor and engage, we believe the quality of engagement is getting much better. The deal size is getting larger. We all have to focus to make sure that we are able to improve our win rates. Our consideration, we are being considered. We have to make sure that we improve our win rate to be able to get to that momentum. So I feel confident of what's coming in FY26.
Thank you. That's it from us.
Thank you. The next question is from the line of Aman Soni from Invest Analytics Advisory LLP. Please go ahead.
Hello. Am I audible?
Yes, sir.
What are the key reasons for the delay in the settling foreign currency trade payables and receivables? And what steps has the company taken to resolve the issue with regulators and counterparties? And what is the expected financial and compliance impact, including potential penalties or risk to cash flow and working capital?
You're talking about which one? You are saying about the note on the FEMA?
Yes.
So that is not impacting the day-to-day thing. They are more intercompany transactions. They are not third-party transactions. As per the FEMA regulations, all the intercompany receivables, payables, or any receivable payable from overseas, when you do the transactions from India, need to be closed within the 3 years time frame. So these are the, let's say, some of the transactions which were not transacted within the 3 years time frame. So we are working with some approvals from the Reserve Bank to close those transactions, but those are all intercompany transactions. So there is no impact on the balance sheet or on the financial affairs of the company because of that.
Okay. Thank you.
Does that answer your question, sir?
Yes.
Thank you. The next question is from the line of Sheesh Jain, who is an individual investor. Please go ahead.
Yeah, thank you for the opportunity. I have 2 questions. First being, in the previous fiscal, we were on our way of closing our second 100 million customer. So have we been on an annualized basis able to make 100 million plus revenue from both those customers in current fiscal?
So if I understood the question, we said, are we able to get a 100 million customer in this fiscal? Is that what you said? I didn't get the question.
What I wanted to, so from both those customers, have we been again able to make 100 million plus revenue in this fiscal as well?
So yes, we have made $100 million plus revenue from our largest customer, and we will make the year hasn't ended yet, and we expect to make that as well with our second largest customer, almost $100 million. The idea for us is to get into more customers in the $100 million bracket as we move forward into fiscal 26.
How close are we in adding more customers in this 100 million plus bracket?
So we expect in fiscal 26 to add at least one more customer in the $100 million bracket.
Okay. And sorry, last question. Earlier, we were very confident that because of our GTM strategy, FY25 shall be a flat year, and FY26 is where we will reap the benefits of this new strategy. But the updated FY26 guidance suggests that we are targeting a lower growth in FY26, despite a relatively healthier macro environment, especially in US, and there has been strong capex announcement from all the hyperscalers. So I wanted to understand what changed for us. Why are we holding back in FY26 despite a healthier macro environment?
So we are taking into account the revenue to be achieved in the fiscal year, the guidance for revenue. We expect our order book momentum to be significantly better and larger with the macro environment, AI adoption, and so on and so forth. But we also have to see the timing of our projects and win rate. So we expect our fiscal 27 to gain larger momentum with respect to the order books that we'll have. So we have to ensure that we are able to convert those order book into revenues, and that requires a certain timing of those orders. As we expect to gain larger order book, larger size from our large customers, the runway to be able to convert that into revenues may not be enough for us to and therefore we are being a little conservative in terms of guidance. But we believe the fiscal 27 will have much better momentum at the back of order backlog and wins that we'll have in fiscal 26. So that's the reason we want to make sure that we are able to deliver from a revenue standpoint.
All right. Thank you so much. That's all from my side.
Thank you. The last question is from the line of Lakshya Agrawal from Growth Sphere Ventures LLP. Please go ahead.
Hello, sir. Thanks for taking my question. So firstly, I just wanted to understand that in our data center segment, like we had earlier also mentioned, that 20% of our revenues coming from there, and we want to move towards 25 to 30%. So I just want to understand that what service exactly we provide in the infrastructure network development. Like I do understand that we put fibers and we put the passive infra, but if you could give some more detail on it.
So yeah, we expect our data center revenues in our $2 billion goal to be in the range of about 25% as we get into the next 3-4 years more so. So that's our goal. With respect to what we provide, we largely provide connectivity infrastructure, which is the core of any data centers, which includes structured cabling, passive infrastructure, the fiber to the racks, the wireless infrastructure into the campus. We're largely a networking connectivity provider. The networking connectivity is about 10% to maximum 15% depending upon the size of a data center build-out. A data center build-out requires in America about $10 million ballpark average per megawatt. So depending upon what we win, if it's a 200 megawatt build-out, that possibly spend $2 billion, the total opportunity for us in providing connectivity network infrastructure is about $200 million. We are not only the sole provider, sometimes we are. So we have a significant opportunity to do that. We can also do more than that, but considering the scale, I think customers buy differently in a hyperscale environment. So our larger focus at this time is to be the best in providing connectivity, networking, wireless, some other private LTE infrastructure for a data center campus, which is a significant opportunity, which is about 10% of the total spend of total capex spend. So that's what we do in the large-scale hyperscale data centers in the US.
Understood, sir. And secondly, who would be our close competitors in this space, and how does our margin profile look for this segment compared to the same networking solutions which we provide for healthcare and finance and different other segments?
So our peer groups in that space in North America includes the likes of Direct Line, IES, which is a public company, E2 Optics, and some more, Vision Networks, and some more. The margin profile for connectivity compared to other, when you go larger, the overall margin profile is slightly subdued. The margin profile for data center infrastructure networking from a gross level in the range of 20%. Whereas if you do a healthcare, of course, the scale will be much lower, in the range of 25-26%. But with respect to being accretive to operating income, I think both would be the same because the cost to serve a large client with respect to sales cost or other overheads is lower. So it will balance out with respect to our goal of operating margin of 10%. So both of them are equally accretive because larger volumes require lesser overheads to serve.
Understood. And lastly, on the client acquisition strategy, is it the years of experience and the client base which we have, so which will give us the recurring revenue, or do we also provide some lower pricing from which we are able to add new customers? So what is our exact strategy on this?
I think yeah, you have to be competitive at market pricing. 1 or 2% would not really make a difference. Your right to win is largely a contextual based on your experience, based on the relationship we have, ability to serve globally for many of our customers. So I believe a combination of long-term relationship, providing relevant technology solutions with knowledgeable and highly skilled people, and providing, of course, ability to serve them globally at market cost will allow us to improve our win rate. But largely, it is our relationship and the relevance which will count to be able to win that.
When you mentioned relationship, I understand that we can get extra business from our existing customers, but to get new customers, what exactly do we offer over there?
No, I believe when we talk about, first of all, we are focused on our bunch of customers. We have very many customers. The total addressable market within those customers for increasing share of wallet is very, very large. Not to say that we not look for newer customers. Of course, we all want to look for newer customers. And to that extent, our investments in sales motion, vertical leaders are based on their ability to bring those relationships back to us, right? The people have served those customers a long period of time. So serve your existing customers, increase share of wallet. If we are providing one set of solutions, we can provide others and therefore increase share of wallet. That's our larger focus to go deeper into an account. We have very many market customers. And with respect to hunting or getting newer logos that we must want to win, our investments in newer salespeople, top quality talent will allow us to start those conversations, which will eventually lead into building of a relationship and winning those deals.
Okay, understood. So thank you. Is it possible if I can squeeze one more question? So I guess I'll just ask one question. I just wanted to understand that how does a pipeline look like in terms of numbers, if you could provide, and what is our conversion rate for the same?
So as I said, our current pipeline for getting into Q4 and beyond looks large. We are looking at pipeline in two parts, a large value deal pipeline, which is our focus, and that's what has grown over the last several quarters, which will allow us to win some of those as we move forward. Our win rate in smaller deals has been much robust at 35-40%. Our win rate for large deals historically has been lower. So our focus now with verticals that we have brought in horizontally is to increase the win rate that I told earlier to about 20-odd%. So that's our focus. And if we were able to do that, which we are confident about, we should be able to deliver the organic growth that we're talking about over the next several years.
Okay, understood, sir. Thank you.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
I would like to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with Purvesh Parekh, our Head of Investor Relations, or with Strategic Growth Advisors, our Investor Relations Advisors. Thank you.
On behalf of Black Box Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.